All right, everyone, welcome back for the episode of the Master Trader Series. Today we have a very special guest, and it is Wednesday, February 19th, 2025. Don't forget to like, comment, subscribe to the channel, and come find me on carnivoretrades.com for swing trading alerts analysis and a live day trading. Our guest today is Infra. He's got a huge following on Twitter, and he does some amazing macro write-ups, and I hear he's a very good trader. My friends tell me he's an excellent day trader. I'm going to say that kind of like Trump does a little bit there, the best day trader.
The best.
But yeah, the best. But in any case, does some great macro write-ups if you're interested in treasury market liquidity, kind of fiscal dominance, any sort of tariffs. He does an amazing job of breaking things down, and he can really cover all bases. So, but anyway, without any further ado, Infra, how are you doing today?
Good. Thank you for the kind words. I try my best to deconstruct some of this stuff and make it as simple as possible. So, yeah.
Absolutely. All right, so let's get right into it here. So you did you've had a couple of like semi-viral kind of threads on X or Twitter, or whatever you want to call it, on mainly like the treasury market and kind of like how there's been a fundamental shift. And I know you're in the same boat as I am in terms of rates and kind of just being a new norm essentially. And can you kind of give us like a 30,000 foot view of kind of the treasury market and I guess how that ties into like the current macroeconomic economy? Are we in a permanently stagflationary environment? Are we gonna see a 2% 10-year again, or are we looking at higher floors moving on, even if we were to have economic slowdowns?
Yeah, so I think a couple of things, but the first point would be, I've read quite a bit structural demographics theory, Neil Howe, Peter Turchin, those kind of guys, and they all describe these longer term interest rate cycles, and this goes back hundreds of years throughout various different economies. That interest rates tend to move in these kind of, we all know the business cycle and the 2-year cycle, 4-year cycle, but interest rates on a secular basis move kind of in 50, 60, 70, 80-year cycles. And we've been in a bond bull market with falling rates since the 70s, and it's when you look at a long-term chart on TLT or the 30-year, the 10-year. It's pretty clear that we've broken out meaningfully to higher rates. So that's consistent with the structural demographic theory, and it plays into demographics, of course, too. Everyone knows about the demographic picture of America. Obviously, we're reshoring, and globalization served as a very disinflationary force. To reshore and truly make America great again, if that's what we're going to do, that's just on its face going to cost a lot of money and be inflationary. And so if those two trends hold, the demographic picture and the kind of more broad, more secular deglobalization trend, if both those things hold, we're just structurally going to see higher rates. And it doesn't mean like I think we're both pretty young, and so this is maybe the first time we're seeing rates this high. But fundamentally, at the end of the day, the 10-year rate is supposed to approximate nominal GDP. So if you have 5% 10-year, nominal GDP is 5%. It's not necessarily a bad thing. I think a lot of the rates picture, people have this recency bias of post 2008 and ZERP and QE, and it was a very low growth kind of world. And in fact, the Fed was worried at times about inflation not being high enough, being too far below their target. So I would just point out those kind of structural factors. And then kind of more broadly, like essentially since the 70s, the Treasury bond, the U.S. Treasury bond, has been the global reserve asset of the world. The dollar has been the reserve currency. Clearly, everyone knows about petrodollar. A lot of commodities are denominated in dollars. But the treasury bond has been held as a sort of reserve asset. And that trend is also, in my opinion, ending. We can see this, foreign holdings. Some data was out today on Twitter. China's holdings of the treasury bond, their bond holdings are down. And of course, it fits in with the deglobalization sort of narrative. If you subscribe to the idea that we are deglobalizing, it does make sense that there will be a move away from a centralized asset like a US Treasury bond. We defaulted on our debt to Russia, right? Russia held, Treasury bonds with, CUSIP IDs that we just decided, nope, those are no good anymore. We're not paying them. And so, that sent a signal in 2022, that the Treasury bond is not the asset you thought it was. We can decide to stop paying interest. We can decide to default completely and quote unquote confiscate that wealth. And so, I think that what we'll see over the longer term picture is a reduction in the foreign demand, and a shift away from the treasury bond being the kind of net settlement layer and reserve asset towards stuff like gold, maybe Bitcoin, certainly gold. And gold has ripped so hard for the past year and a half. And I think it's part of this bigger story that has to do with kind of a move away from the dollar. And it's not a bad thing. Like, the dollar is kind of killing us. You referenced one of my more viral posts. But the dollar, the fact that it is the reserve currency is actually a curse. It may, you tell that to a lot of normal people and they're like, what? That makes no sense. Well, what happens with the dollar being the reserve currency is that there is this kind of perpetual bid, this price insensitive perpetual bid that puts a higher floor under the dollar than there should be based on fundamentals. And so what happens is we have this ever strengthening dollar. You pull up a chart of the trade weighted dollar index, and it's basically at all-time highs, and it's just up and to the right. And that's not how it should be with a country that's running a huge, ever-increasing twin deficit. And in fact, the dollar should be doing the opposite and look more like a TLT chart. But it's not doing that because it is the reserve currency. So as that happens, as the dollar gets stronger, our exports, so if you're an American company making stuff here in America, your exports to the rest of the world become less and less and less competitive. The stronger the dollar gets, the less competitive your exports are. And so what happens is we become more of a consumption-based economy that imports everything. China sends us, cheap Chinese, cheap plastic electronics or whatever. We run a fiscal deficit in order to finance that trade deficit. So we go for, we put our youth further and further in debt via the fiscal deficit, use that money to then send to China, to account for the trade deficit that we have. China then reinvests those dollars into American, capital markets. And we don't have a ton of this. NASDAQ, could be NVIDIA, could be corporate bonds. We don't really know. Part of this whole structure, and basically the kind of agreement was, both parties decide to do this. We will hollow out our industrial base. We will make the dollar the reserve currency, ship run this ever increasing trade deficit, which is how we get the dollars to the rest of the world that needs the dollars. We got a bunch of people around the world strung out, and they're constantly on the verge of withdrawal. And the way that we get them the dollars that they're fiending for is by running a trade deficit, structurally speaking. And so there are really deep structural issues at play. And I was having this conversation, I think yesterday, but we could see, and this would be pertinent for, S&P, NVIDIA, Mag 7 stocks. But we could see if Trump truly, really enacts a weak dollar regime, which is what we would need to do. DXY is at 106, 107. You take the DXY down to like 60. I'm talking a significantly weaker dollar. If that's really what they're going to do, which is what we need to do if we want to reindustrialize, that we could see a flywheel start to develop, right? Like if you're a European, we sent dollars out to you, you reinvest them back into our markets, and say Nvidia just does nothing all year, it's just pancake flat. Well, if we weaken the dollar, if we run a weak dollar regime, and the euro is strengthening, right? If the dollar is weakening, your Nvidia, right? Say the euro strengthens 20% against the dollar from here, and Nvidia does nothing. Even though Nvidia is flat, that European bank or business person or investor is down 20%. So we have always kind of operated under this assumption that like we will act as the world's repository, right? Recycle all these dollars that we're sending out to the rest of the world for your goods, recycle them. We got the best capital markets in the world. Your dollars can have a home here. We'll treat them well. But
so you're saying
if this starts to reverse, it could be dramatic.
So you're saying that reducing that not that we have a strong dollar policy per se, but really introducing a truly weak dollar policy could actually de-incentivize investment into capital markets here, which obviously would have it would be an inverse effect to the unintended consequence, perhaps.
Yeah, I mean, you pull up a long-term chart of the S&P, and the thing's a parabola. And real estate, I point to this quite often. A lot of people look at real estate and they're like, well, this house can only rent for $4,000 per month, but the mortgage is $10,000 per month if you're looking to purchase it. Mm-hmm. Well, that's the monetary premium that's been baked into real estate as a result of this kind of hyper financialization that our economy has.
It only goes
suffered.
Up. It only goes up.
Yeah, and these foreigners, have always put their dollars here because if the dollar is always strengthening, that's a positive carry trade. And so we made our currency, basically a funding currency for the rest of the world, which it all works great. But then you wake up one day, you realize we got no middle class. We can't keep up with a country. We can't, we're underproducing a country with 1/10 of our GDP. We can't even keep up with this small kind of proxy war. We've hauled out our middle class. Wealth inequality is at the worst level since the Gilded Age. The suicide rate's the highest that it's been since the Great Depression. On and on and on. The birth rate is plummeting. You start to get these second and third order effects, and that's why we have Trump.
Well, and another thing about that too, like kind of circling back to what you're saying, like it was a normalized 10-year historically, 5-10%, whatever, was a lot different in 1980 than it is now, considering personal savings rate. Like, this idea of home ownership to the younger generation is such a fantasy, right? It's not that, I'll give you an example. My parents bought their house in 1984. My dad was a mechanic. My mom worked at a greenhouse. That is not possible to do right now. So that rate, while historically at a normal level, highly disproportionately affects the current generation versus previous.
Yeah, so young people, I'm a younger millennial, and I'm completely screwed. I worked in a certain kind of niche industry, worked my way to the top after 15 years. I got the director level position. I got the, 6-figure salary, which here in LA is, not saying as much as maybe Mississippi, but 6 figures used to be enough money to buy a house here. Now you would have to triple my salary, assuming a 35% LTV to qualify for a mortgage. You have to triple my salary of $100K a year in order to afford just a 1,500 square foot 50s fixer upper kind of house in a bad, not so great neighborhood. So and this is a result of this kind of perpetual bid in financial markets that is a direct result of being the reserve currency of the world. And you kind of bringing it back to rates, that's another kind of disinflation, or for many decades, we send these dollars out to the rest of the world and they would buy our bonds because they at least got some interest. The dollar was always strengthening, so that side of the kind of carry was there. And then, they get a little interest on top. That trend seems to also be kind of reversing. And when you have, the rest of the world buying your bonds, that kind of artificially keeps your yields lower than they might otherwise be. And so, if the rest of the world is kind of stepping away from the treasury bond as the reserve asset, that, you remove all that demand. We know supply is kind of ever increasing with these deficits, these insane deficits. I mean, the fact that we're running a 7% of GDP deficit and everything's great, unemployment's great. We're not World War III, and we're running at 7% of GDP.
Yeah, I mean, it's insane. DoorDash just announced that they're close to profitability now. That's a company that they never thought. And it's like, how's that working right now? I can't wrap my head around that one, but I guess it's working.
I mean, so here's the thing. It's very bullish for gold. It's very bullish for Bitcoin. It's very bullish for any kind of neutral asset that floats in all currencies. I think it's pretty clear, especially under Trump, that this is the direction things are headed. We're going to have higher yields, just kind of structurally speaking, because of deglobalization, demographics, and reshoring. And, there's a very concerted move away from the dollar and from the treasury bond as the reserve asset of the world. And what do you look to? You look to gold, Bitcoin, anything that floats in all currencies. This is the way, I always point out, this is the way it used to, our idea of this kind of fiat system that we have for global trade and kind of macroeconomics. We talk about it as if it's just kind of normal, but in fact, for hundreds of years, especially during the mercantilist era, take it back to the 1500s, gold was the reserve asset. If your country was a strong economy that produced more than your country consumed, you were a net producer, gold flowed into your country, and your country accumulated more and more gold from that trade surplus. Now, with the dollar, it's all screwed up. And our dollar's been, getting stronger and stronger and stronger, making our exports less and less competitive, and kind of hollowing out our industrial base more and more and more when we're running a huge fiscal deficit, and then a huge trade deficit. These both deficits just continue to get worse, and it's getting pretty dramatic. And yet, you look at the Dixie or trade weighted dollar index, and it's, basically at an all-time high on the trade weighted. So yeah, it needs to, if we want to truly make America great again, and I'm sympathetic to some of that kind of those ideas, we need to move away from the dollar as the reserve currency and away from the treasury bond as the reserve asset. We're going to have higher rates. I believe that it's are also going to have kind of higher inflation. Yeah, it's definite. There is no world, we're not getting out of the box that the past 5 decades of politicians have put us in. Not getting out of that without some pain. And here's the thing, I think that there is a possibility that Trump, people like Russell talk about this shift from capital towards labor. And that kind of cycle is also a 50, 60, 70-year cycle. And we've prioritized capital for a long time in this country. And you look at the S&P, look at real estate, whatever. and you can see it. But if Trump is really willing to break things and really trying to do this agenda, we could see a start in the shift away from prioritizing capital towards prioritizing labor. Prioritizing the average guy just out there trying to put food on the table, making 50K, 60K, whatever a year. That guy, his wages as a share of GDP have just gone down every single year for like 50 years as a share of GDP. You divide the average hourly wage by M2 money supply, and it's just down relentlessly. Divided by gold, down relentlessly. So the productivity gains, are not going to the average American. This is why we get the kind of populism that we're seeing. But it's, all this to say that I think the picture for a lot of these things could look radically different than kind of what we're used to.
Yeah, you actually were about to just say what I was going to say is about populism. And it's funny, you and I were just talking about this earlier before the show about how Elon was like pushing for the $5,000 rebate. And I saw the headline and I was like, what is this? UBI stuff. But, it's actually, as we found out, it was only targeted at, or only people who are net payers of income tax are qualifying. So there is that, it does seem like there's that populist drive. And it does seem like they're trying to, I guess, follow through on it. I didn't believe that would ever be a thing, but I guess maybe times are changing a little bit.
Yeah, it's possible. The average person has been, anyone with TradingView, just go put average hourly wage divided by GDP. It is a brutal chart, and then replace GDP with M2 or gold. I mean, all of them are brutal. Like the average person has just been getting hosed relentlessly by both parties for 5 decades. If you own financial assets, if you're older, maybe a little wealthier, and you're able to own a home and got your stocks and whatever, those people are okay. But I think what's happening is it's becoming a young Zoomers and millennials. We don't have a lot of financial assets, so it's becoming it's just becoming more evident, this hyper financialized K-shaped economy that we have, that really comes down to, do you own financial assets or do you work for a living? And you also look at just a very simple kind of example here. You look at capital gains. Capital gains, long-term capital gains, is like half of the tax rate of income. How does that make sense? Well, it's clear that we've prioritized capital. And look, I'm not a communist. I'm not one of these crazy far left young people. But it is important to point out that the economy we have is not a free market economy. I mean, we have 14 however many Fed officials that are unelected deciding fixing the price of the most important thing in the world, which is the cost of money. And they're unelected. No one voted for Jerome Powell. No one voted, of course he was appointed by Trump. And, but my point is, a lot of people like to think that we have this capitalist system here, this free market economy, when in reality, you look at the bailouts after 2008, or just go down the list, like we are far from it. And I think it's okay to be critical of some of these things, and to speak up for the average American that has been working hard and has worked their way up the ladder and is just getting hosed.
What happens in the next, half a generation or generation, where you get a older generation that's dying out that does own all the assets? And, the only way that millennials or Zoomers or, whoever the average person is, has a chance of owning any of those assets or any share of that wealth or home ownership, whatever, and they just inherit, right? But they can't become buyers because they don't have the buying power because they were priced out. Does that create, sort of a hole in demand?
Yeah, I hear a lot about the silver tsunami and this story of how much the Zoomers and millennials are going to inherit. you know, I, I don't really have a clear opinion on it. You know, the kind of cynical side of me thinks that, given how acute the fiscal crisis, you know, I argue we're already in a debt crisis in the early stages. I mean, you know, over 20% of tax receipts are going to interest. So, you know, if we were an African economy or a, you know, in South America or something, the IMF would be sending
Right.
in the blue helmets at that level. I mean,
Right.
20%
Right.
of revenue is going to, that's
Right.
crazy. And so the fiscal crisis is kind of so bad that, like, the cynical side of me thinks they will just tax all that wealth that the boomers have, that, you know, have accumulated, that they will just tax the ever living hell out of it, as a way to try to prop up these kind of insolvent or nearly insolvent entitlement programs and kind of
Right.
debt
Push it
interests.
down the road.
Yeah.
Yeah. Yeah. It's an interesting prospect. Um, about, you mentioned a minute ago about the deficits, and we haven't even gotten to the T word, but we'll get there soon. Because I know we got close, but so about them cutting the budget. You actually recently did a thread about this, and how much collateral damage balancing the budget would actually do and what that would require. But before you talk about that, Besant really just recently said he does not see a change in issuance anytime soon. So does Doge even matter? If we're not changing issuance, then that means that, okay, we might be cutting it from somewhere, you know, cutting government spending from somewhere, but if we're not changing issuance, and then debt is created to just another place.
Yeah, so Doge, and I will just take a short victory lap. Like, I saw a couple much larger accounts basically rip off my work. I you know, I just did the math. I think it was like October the first time I did a post about it. I just did the math, and I'm like, you know, this would be a recession, because back then Elon was talking about taking 2 trillion out of the, you know, essentially we're running about 2 trillion deficit each year. He was
2.1,
saying, you
yeah.
know, 2.1, and he's saying, you know, we're
Yeah.
gonna basically balance the budget. And I just doing the math, and you know, the math that I got, and I laid it out very clearly, you know, for anyone to criticize or correct. The math result would, if you cut $2 trillion from, you know, each year and balance the budget, it would result in a contraction of GDP, worse than the 2008 Great Financial Crisis, and worse than COVID. Now, like, whether or not you believe GDP is a good measure of the health of an economy is a separate discussion. You know, like, I don't really think when 30 something percent of GDP is just government, you know, currency debasement, it's clearly kind of a broken measure, but it's the measure we have. And, you know, like, it indicates the level of pain. The main point that I had for writing that post was not saying that they're wrong to try to balance the budget, or that they're wrong to try to cut all this spending, but more, we need to prepare ourselves and be upfront, you know, with the American people about what doing that actually would entail, what it actually results in. And when it comes to Doge, I'm the idealistic side of me, the ideological side of me, you know, hopes that they balance the budget. But kind of going back to the dollar thing, until we fix the dollar as the reserve currency, and kind of as a second order effect, the trade deficit, until we fix those two things, we must run a fiscal deficit to finance the trade deficit, which we have to run as a result of being the reserve currency issuer. So, you know, I'm kind of in the camp, at least now, from what I've seen so far, I'm kind of in the camp of, like, they're talking a lot, but, like, no one's talking about the root causes, which is the dollar, and the trade deficit. Clearly, you know, Trump is trying to tinker around the edges with tariffs, which I think are misunderstood. But, you know, when it really comes down to it, like, I don't think that Doge, I think it's a good program, and I think that they should cut as much as possible, but I just don't see them kind of like purposefully, knowingly putting us into a recession, a GDP contraction that severe. I just don't think they have the political capital to do that.
All right, yeah, and that's the thing, right? Is that it's just very, the general public doesn't understand that there's realities to, cutting spending, cutting, being, having austerity, and all they understand is that my paycheck went down, right? And nobody explains that right before you vote, and there's all they know is my hours went down or I lost my job, and that's the reality of what has to happen. And like you said, not many politicians have the political capital to do such a thing.
Yeah, I would say that like JD Vance, I think is interesting. Trump, I'm critical of Trump, mainly on the dollar reserve currency topic, where he seems to have a disconnect. But on the other hand, like JD Vance, who I think represents kind of the new MAGA, JD Vance, actually, you can find it on YouTube. Questioned Jerome Powell, when he was in the Senate, and actually pressed him on Triffin's dilemma, on Dutch disease, resource curse, all the things that we started the conversation. JD Vance understands this stuff.
For people who don't understand, what is Tritton's dilemma?
Triffin was a Belgian economist in the 60s, I think, came over to warn us, if you guys want to be the reserve currency, that's okay, but you're going to hollow out your industrial base, and hollow out your middle class, and it's just a structural result of having to run these huge trade deficits to basically get the rest of the world the dollars that they need. As the dollar strengthens, your exports can become even less and less competitive. Meaning you need to import even more. It's it's a vicious cycle.
Right. And then you get stuck between kind of a rock and a hard place where you have to just, decide what you're going to save essentially. And there's no good answer really.
Yeah. And we're at that point now. Like I firmly believe that if we don't do anything to radically change the system, like a move away from the dollar and towards gold and or Bitcoin, so just some kind of neutral asset. If we don't do that, like, sure, it's possible they just kick the can, no real change happens, but then suicide rate continues even higher. Drug overdose deaths continue even higher. Birth rate plummets even more. Political polarization increases even more. And eventually, the system can go on like this, but there is a breaking point, and that breaking point is Marie Antoinette-like scenes in Manhattan and Los Angeles and Washington D.C. And most people I know don't want to ever see our country come to that, but that is the consequence. If we kick the can and do not address some of these major fundamental structural issues, that is the inevitable kind of conclusion or result.
So what about tariffs though? Doesn't that fix everything?
Yeah. So tariffs are my big thing with tariffs. And I did a whole post with I think some good charts in it to illustrate this. The main issue I have in the tariff discussion is a lot of people say they're so inflationary, and that's why we shouldn't do it. It's a tax on the American consumer. And what is missed, and it's understandable that normal people miss this, because macroeconomic international trade is pretty complicated. But what's missed is the currency. And so that was the main point of my tariff article, was to illustrate just how that currency offsets the kind of inflationary impact that you might have from a tariff. As a very simple example, we put a 10% tariff on Mexico. All imports from Mexico, 10% tariff, 10% kind of added extra tax. But then the dollar versus the peso or the dollar strengthens by 10%. You've just completely neutralized any kind of inflationary impact. And this is why, if you look at the Canadian dollar, the peso, the euro, even the yuan to some degree, you'll see that these currencies have all been pricing in tariffs for many months now. Even before Trump's election, in some cases, you could see these currencies start to weaken, dollar strengthen, even back in like October, November. And so that's my main point with tariffs, that if there's one point on tariffs, it do not believe this talk that it is just kind of naturally inflationary, because as soon as you start factoring in the currency and the offsetting move of the currency, during Trump's first term, the yuan fell by like 14%. And CPI was actually below 2%. And I have it all labeled with, every little update of the tariff war. And you can see CPI in the bottom pane there, and it was below 2%. It was not hyperinflationary to have tariffs on China. And so that's the main point that I think people should understand with tariffs. It is a helpful tool to try to kind of rebalance global trade, because American companies just cannot be competitive without tariffs. The problem is that the real root of the problem is the reserve currency, and this kind of perpetual structural bid under the dollar, where the dollar just continues to strengthen and strengthen and strengthen, no matter how bad our fundamentals are. That's really the root problem. So tariffs, theoretically, they can help to kind of rebalance trade. And I do think Trump is right that some of these trade arrangements are screwed up.
Oh, 100%, yeah.
But it's not until you fix that dollar issue, the reserve currency issue, the kind of Triffin's dilemma, resource curse aspect. Until you fix that, tariffs are just kind of a band-aid. Yeah, it might, on the margin, it might improve the trade balance, but really kind of the root of the problem is this reserve currency status. And so, yeah, I certainly don't think
all these other countries own say $30 trillion. They all own each other too. So, and that's dollar denominated.
Yep. Yeah. So just kind of to that point, like if people aren't familiar with Brent Johnson's milkshake theory, dollar milkshake, it is a reference to that. And I subscribe to that. I've talked to Brent. I think he's a really smart guy. I know he's polarizing, but I think he's correct.
He gets a lot of backlash, but I haven't seen him be particularly wrong yet. So
yeah, and the milkshake theory that he laid out in 2012, I think, or 13. Gold's going to go up, S&P is going to go up, and the dollar is going to go up all together, and that's kind of what we're seeing. And so so to your point, the rest of the world has so much dollar denominated debt, tens of trillions. No one knows exactly for sure how much, but estimates are above 20 trillion. And you have so much global trade and commerce denominated in dollars that as the dollar strengthens, that is squeezing the rest of the world. Like, imagine if you're a European, businessman in Germany, you are short the dollar. And so as a trader, just picture, pull up the trade weighted dollar and imagine you got short on that 5 years ago when you opened your company. The dollar squeezes and puts immense pressure and immense pain on foreigners that they are short dollars kind of by definition because of how big the euro dollar system is. They are short. And this dollar just keeps strengthening. And so it's squeezing them further and further and further, squeezing them more and more. And this is why, like Japan, there is this huge correlation that I found between the price of oil in 2022 and the 10-year yield. So as the price of oil ripped higher, Japan, who must import all of their energy. The price of oil, like they are also short oil. Europe, South Korea, Japan, these countries are short energy, especially oil. And so that as oil is ripping higher and higher, it's pushing their current account deficit worse and worse. They need to finance energy purchase. Energy is the most core, can't get around it. You need it. And so what did they do? But they sold, treasury bonds. And the 10-year correlation with the dollar and oil, I have a thread from back then. You can see it very clearly. Like
you can see pretty clearly if you just line them up.
Yeah, the world is short energy and they're short dollars.
And it's also good. I mean, just in general, 10-year yield oil correlation, even just domestically, it's an inflation gauge too.
Oh, for sure. Like gold. Yeah.
Yeah.
Yeah. There's
a couple other things here. Well, yeah, go ahead and finish.
Well, I was just going to say that, there's that correlation is there for multiple reasons. I'm not trying to say it's the only that the 10-year was rising purely because of that, but it is going back to our first discussion about the bond market and demand. Like we need all the demand that we can get if we're going to run a 7% GDP deficit and refinance, over 9 trillion this year. We need all the demand we can get. And so the price of oil starts moving much higher. That'll significantly hamper the balance sheet capacity and demand for bonds.
Absolutely. All right, let's get into a couple other things here before we start to wrap up. It was very well timed thread on X. I believe it was August 3rd, and you wrote why a pullback may not be allowed, which the reason I say it was well timed is because that was it would have been Saturday, the day before the August 5th gap down, which that's where the low was in the S&P. And why is it that financial markets are so tied now to really everything, and why are they so important now? I know we know they're important in general, but
it kind of goes back to many of these problems are a second or third or sometimes even first order effect of the reserve currency status of the dollar. So kind of what we were talking about before, the agreement with the world was we ship our jobs in our factories overseas. You make the stuff for us for cheap. We send you dollars for those goods, and then you reinvest them into our capital markets. And so this is called hyper-financialization, where a country's economy starts to, and it is found often with reserve currency issuers due to just the structural nature of how that works. And so like the S&P, for example, in the dot-com bubble, the S&P fell by about 48%. Obviously, QQQ was worse, but S&P fell by 48%. Tax receipts fell by 30%. And then after 2008, the decline was 55% in the S&P. Tax receipts fell by 32%. And even 2022, which of course the pullback was not nearly as bad as .com or '08, but even in 2022, when the stock market fell 26%, tax receipts fell by 12%. And we get about 5 trillion in tax receipts per year, and that's heavily tied to the performance of our financial markets. And you can overlay the tax receipt data, the overall receipt for the federal government with the S&P 500, and it looks identical. It looks to be a perfect fit kind of line. And as time goes on, the high gets stronger.
The max gain gets higher, the higher floors.
Yeah, and like the thing is, we're the starting point is 7% GDP deficit. It is already this kind of insane level. Tax receipts are already interest is already over 20% of tax receipts. Mandatory spending is already over 100% of tax receipts. And so that's the starting point. If we were to see a significant 20, 30, 40, I know some people even, recently calling for an 80% correction, what that would do to the tax receipts, that would blow our deficit out to, by my calculations, between 15 and 25% of GDP. And once you get to that level,
and the rest of the world would look 80%. I mean, you'd have to imagine.
Yeah, the rest of the world. This talk of this significant pullback. I know there are some bears that I listen to on a daily basis that have been bearish the market for years now. A few years now, and what they're missing is that the system, we agree that the price to earnings ratio is insane. Valuations are stretched. We agree that the chart just itself kind of looks crazy extended, especially if you look at like a 3-month chart and zoom way out. Yeah. I agree with all that stuff, but the other side of being, I think, an informed market participant, you have to understand that just because something should be a certain way doesn't mean that it is that way. You got to play the game that you have, not the game you want. And at the end of the day, the government needs the stock market to go up, because that is the primary driver via the wealth effect for consumer spending and via capital gains as for government revenue. And we know their fiscal position is already acute. So it is in their best interest to have the stock market just keep going up, because capital gains, and their revenue will continue to go up. And the wealth effect, consumer spending, which is such a large portion of our economy, it finances that too. And in the US, the top 1% own about half of US equities. The top 10% in the US own 93% of US equities. So what I am saying, the second order effect of that is wealth inequality will continue to get worse.
Yeah. And we could do a whole, you were like almost talking my language there for a second. We could do a whole episode on not having the market you want and not the one you have. That's something that I've really drill home into my subscribers and my clients. But it's heck, look at to bring back to the .com bubble, Alan Greenspan's irrational exuberance comment came in 96, not 99, 96. The NASDAQ went up 100% from there. So when you think it's euphoric, it might not be as euphoric as you think it is. It can go higher. And like you said, this is tied to the using charts. I'm a technical trader too, but when you have an outside entity that's interfering with the chart, it's not you're not charting emotion anymore. You're charting something that's being tampered with.
Yeah, and
at least on a long term basis. Short term, you can still, but on a long term basis, it's they're being supported.
Yeah, and it goes back to what we were talking about earlier with young people. It just screws them even more, because if you were a boomer in the 70s, you have your excess earnings and you invest it in, pick a stock, right? They could throw a dart at a dartboard of names, right, of tickers. Pick, and it's up 4,000%, right? Now, I don't recommend to any young people that I know, I don't recommend that they put their excess earnings into the S&P, for example. You can find better values, right? Usually companies that are not doing so well. You can find kind of a long-term chart that isn't buying the top of a parabola. But it makes it hard, because we part of why they have the return has been so great for boomers is the price to earnings ratio has expanded. And, Raoul Paul points this out a lot, but the price to earnings ratio is really kind of misunderstood. The price, if we are debasing the currency by 8-9% a year, and there's just that much more money in the system for purchases of the S&P 500, the earnings are going to do what they're going to do and try to keep up with real GDP growth, hopefully. But the price is going to, the amount of money and therefore the price of the stock, since they're somewhat limited, scarce assets, the price will just continue to go higher and higher and higher. And the earnings are stagnant. I'll be the first person to admit that.
Or if they do buybacks like Tim Cook.
Exactly. Yeah, and so they do these kind of artificial, means of propping up their share price, and of course there's stock-based compensation and the whole kind of element of that Mike Green talks about a lot. But yeah, no, it's just again, going back to it's not a free market. There are so many examples of that you can point to that indicate that you're kind of playing a rigged game, and the rules aren't fair. And just because something should happen, if anything, it means it probably won't happen, just due to the nature of the system.
It takes a long time. I fought the fight, and one thing I always say is never be an idealist investor, because ask me how I know that.
Yeah, I've gone down that road too. Had to bang my head into a brick wall one too many times, and realized that the wall was not moving. So yeah, it's the kind of thing you learn with age and experience. And when I say a lot of this stuff, it's not, I'm the first person to criticize the structure of the system, but I'm also trying to not lose money, so
exactly.
You can admit that both are true.
Right?
Yeah, both can be true, right? You can want the system to be a different way while also admitting that it is a very powerful, deeply entrenched system, if that makes sense.
Yeah, absolutely. All right, real quick here, a couple of things to wrap up on. Let's just get into kind of maybe some kind of current things. I just want to ask you about reverse repo dwindling down. Bank stocks still seem to be performing well. JPM's at all-time highs. Even the regional banks doing okay. Morgan Stanley, Goldman, they're just off of all-time highs. Is there anything going on here that could be a headwind for the market here, even if it's just in the near term, or some sort of corrective risk here, or will they just come up with another program that makes it not matter?
Yeah, actually, just there will be an article coming out that I just finished writing for Bitcoin News, and I address this exact issue because there's so much. At least I was seeing a ton of doom posting about the RRP, and kind of thought it was a little extra. Basically, the RRP was sterilized. We printed way too much money, and the reverse repo program was a way for the Federal Reserve to sterilize some of that kind of excess money printing. And now, as most people are well aware now, the reverse repo program is, basically down, I think, like 80 billion. It's basically empty. Yeah. And that would indicate, right, like on its own, in isolation, that would indicate kind of a negative liquidity factor. But the problem is that what people were missing, I think, is liquidity is an aggregate. Money is fungible. And so, yes, this one particular measure of liquidity, which is certainly important and definitely has an effect on liquidity. Yes, that particular program, that particular liquidity measure is down. But if you look at the Fed balance sheet, obviously QT is continuing, although I think as of today, it looks like they're pretty much on board with stopping QT soon. The Fed balance sheet minus the reverse repo minus the Treasury general account, that's my measure of kind of aggregate liquidity. And if you look at that, liquidity's been flat like for 18 months, just kind of in this really tight little bull pennant. And it looks like it is, clearly, aggregate liquidity is not a tradable thing, a TA kind of thing. But like
Right.
as someone who trades, you look at that and you're like, this is a picture perfect bull pennant, and it looks like it's about ready to make a big move up. So I think, the Treasury General has quite a lot of cash in it. I think about 800 billion,
Yeah.
and that's the government's checking account, basically. So that can be, if that's spent down, I mean, that almost $1 trillion is there, just kind of sitting there collecting dust that can be spent out into the economy. Also, I'll point out the kind of gold revaluation. If we were to do that, that would deposit, another 800, 900 billion, depending on the estimate that I've seen, so now you're looking at close to 2 trillion in kind of available cash that they can spend out into the economy kind of anytime they want. And that's a lot of money. And so from the aggregate, the reverse repo might be down, but kind of in the aggregate, zooming out, liquidity's basically been flat for 18 months. And it does look though like it's about to move higher.
I'm glad you mentioned that, because I've been kind of saying for a while, like, we had this recent, it's cooled off now, but, we had this recent, the kind of meme coin craze. And I just said to, people, like, this does not look like an illiquid market to me. If the market was going to go down, even with the December FOMC, where we had that big slice, Bitcoin, we had everybody's favorite, Fartcoin, Pepe, like ripping to new all-time highs. If anything, if liquidity is coming out, those should be going down before the NASDAQ does, weeks in advance. So, I'm glad you brought this up, because and there's another thing too. Reverse repo, it's dwindling down, so it's not like it's sneaking up on the banks. It's not like it's sneaking up on the Fed.
Exactly.
So
they know.
They're going to know that what they have to do to take care of things.
Now, the only thing I would point out that could be an issue is more the effect on bank reserves. And you mentioned bank reserves. There is this kind of term, like typical Fed kind of thing, that they call the lowest comfortable level of reserves. And no one knows what that is. And so, they, like so many other things, just kind of estimate what they think the lowest comfortable level of bank reserves is, but they don't really know what it is. And so a couple of things that I watch that might be helpful for people in terms of kind of credit stress and funding stress. I look at the SOFR Fed funds spread for one.
Mm-hmm.
And you can see these kind of gyrations towards the end of quarters. You can see that spread notably increase. I also watch LQD over HYG, which is kind of just more corporate credit spreads. But there are ways to kind of see if there's any stress building. And towards the end of December, it did look. Now it's hard to differentiate. Is this just end of the quarter, end of the month sort of thing, or is this kind of more lasting, more permanent, durable credit stress? And of course, early January, that spread came in, and everything looks much better now. But it is something to keep an eye on, because no one really knows what that lowest comfortable level of reserves is. And it could, there is certainly a possibility that they overshoot the mark, and things get too tight, and we see a repeat of 2019 reverse repo rate spike.
That seems to me like the best, and we'll wrap up here soon. We taking up too much of your time, but that seems to be kind of like the best hope, best case for bears is you get these air pockets where you could get a Volmageddon very quickly, and then it's rubber band right back, because of obviously all the things that we discussed. But and maybe we're kind of coming into that and into Feb OPEX or post Feb OPEX here, which is in a few days. But it does seem like there's kind of this very much higher pain tolerance for the Fed and the government in terms of equity prices.
Yeah, I mean, I put kind of like a look ahead, what to watch in the coming year sort of article in November. And the main thing that I was trying to predict or warn people is volatility. I think that the one thing that you should kind of rely on in the coming year or two is just increased volatility. And like we've seen that, right? Like stocks have gone basically nowhere since December, except that in the middle of that, of course, there's been tremendous volatility. So it's great for traders like us. But from a long-term perspective, like I predict that there will be more of this kind of chop volatility, significant sometimes. And I think, VIX will be an important indicator to watch, obviously, for kind of fear. But it appears to me like every time the VIX gets down to like, the kind of mid 14s, something happens. China releases a AI program, or Trump announces tariffs, or whatever. The stock market gaps down low super hard, negative 2% plus on a Sunday evening. And then, like you said, just kind of grind back, close the gap. And we've seen that now, 2, 3, 4 times, starting with the Fed, the FOMC meeting in December. There was quite a lot of volatility following that. But yeah, it's just this huge kind of range and immense volatility in between. So for me, at least, kind of overall, I am not super bullish on S&P, given the amount of volatility that I think S&P might close higher in December than we're at now, but the volatility that I think we're going to have to stomach, for me at least, is just not worth it.
So you're speaking in terms of more like a position trade?
Yeah, longer term. Yeah.
Okay, got you. Yeah,
I am very bullish on gold and Bitcoin, and I think commodities could start to see a leg higher over the next 6-9 months. And another kind of longer term trade that I'm becoming increasingly confident in. I haven't taken the trade yet, but is a long yen, short USD. I think it's pretty much the only developed economy where the interest rate differential, which is one of the many fundamentals that drive a currency, the interest rate differential could actually increase compared to the US. They have strong wage growth. Their economy is finally kind of coming out of the what they call it, the forgotten decade. Their economy is doing they're doing quite well over there. It's quite strong. I think that they also will be immune from a lot of the trade issues, tariff issues. I think that they are perfect intermediary in this kind of coming age that we're going to see. I think that they're just geographically and also kind of structurally, they would be a perfect intermediary. And I think Japan, I think that the yen could strengthen significantly versus the dollar. I haven't taken the trade yet. I'm not 100% convinced of it, but that would be the other kind of long-term asset that I'm kind of bullish on, in addition to Bitcoin and gold.
Yeah, they don't seem too bothered by any of the tariff talk here.
Yeah, well, they're completely immune. Like we had the Japanese foreign minister, finance minister. One of them was over here, and Trump had a little news conference, and like you can just kind of tell that there's a bunch of agreements happening in the back rooms. And what do you know? There's been no discussion of any of these tariffs applying to Japan. Now that could
Right.
change, of course, but at least for now, if they are one of the few countries that is immune from tariffs, that would be very good. In addition to the kind of strong economic growth that they're seeing, strong wage gains. I would point people, if they haven't seen, to pull up a chart of the JGB 10-year. It's we think our yields start to get out of control, but man, that chart is pretty crazy.
Oh yeah.
And they
All right,
got,
well,
they
for
got like
awesome stuff.
yeah, go ahead.
Go ahead. I'll cut you off.
Oh, I was just gonna say, yeah, like for them, their fiscal debt picture is even worse than ours. In terms of debt to GDP, I think their debt to GDP is like 220, 230%. Ours is close to 120. So, there could come a point where that gets away from them, and I don't know what they end up, what the intervention looks like. But the other thing is, like, the central bank owns most of that debt. So it's certainly something to watch. I would say that I've seen some doom posting about Japan and the 10-year and the yields in Japan. I don't think that it causes. We could see the kind of short-term issue like we did with the carry trade in July, August, whenever that was. We could see that kind of thing, but like in terms of like a global contagion kind of crisis, I don't think so.
I think a lot of it was leveraged short volatility, personally. But
yeah, that got
anyway,
around,
Yeah. Anyway, Imra, awesome. Thank you for your time. Going a little bit over an hour. Again, if anybody wants to look you up, where can they find you on social?
I'm only on Twitter, INFRAA_. And I guess my account's getting big enough that there's imposters. And so I'm the only one with the blue check mark. So yeah, make sure you follow the right one. But it was a good discussion.
Yeah, we'll put your official link in the comments in the description.
Perfect.
Yeah. All right. Thank you, buddy. We'll have to talk again soon, and maybe we can talk more about trading or anything other technical. But awesome discussion, and hope everybody liked it. Anyways, don't forget to like, comment, subscribe to the channel. Go find Infra on Twitter. You guys take care and have a good one.